Welcome to Equity Security Analysis. This week we're evaluating a firm and its prospects from the perspective of a current or potential investor in its shares. Equity security analysis is undertaken by individual investors, analysts at investment banks or brokerage houses, or funds management institutions. Evaluating the prospects of a firm from an investor's perspective involves considering the broader investment process. You commence by establishing the investment objectives, that is, including an investor's appetite for risk, how long they plan on investing for, and what sorts of constraints they might face. Next, we form expectations about risk and return, and then determine what class of assets we will invest in. The major classes of assets that managed funds invest in include cash or money, so money market funds that invest in government bills, certificates of deposits and bank bills, bonds or fixed interest funds that invest in debt instruments, equity funds that invest in equity securities, balance funds that hold cash, bonds and equity securities, and property funds and infrastructure funds. Our view on market efficiency will dictate in part our approach to assessing the prospects of our equity securities. That is, our beliefs on the extent to which financial markets quickly and accurately impound information. If we believe that our equity markets do impound all available information quickly and accurately, this would be strong form market efficiency, then there would be no need to undertake research and analysis to try and identify mispriced securities. On the other hand, if prices do not reflect all available information, then there are opportunities to identify potential profitable investments that might outperform the market or our benchmark overall. There has been much research investigating the extent to which markets are efficient or not. Evidence in favour of market efficiency includes the fact that markets react quickly, in some cases within trades or seconds, to new information, and also the fact that professional fund managers are unable to consistently generate abnormal returns after transactions cost and fees. Evidence against market efficiency includes the fact that markets cannot be efficient in equilibrium. If prices contain all information, there would be no incentives to acquire and process information, and new information would not be reflected in prices. Efficiency also implies that there would be little trading, but we observe large volumes of trading every day. There is also a large body of evidence to suggest that returns are, or at least have been, predictable when securities are sorted on observable characteristics. We see short-term momentum and long-term reversal of prices, along with anomalies like the size and value anomaly over long periods. A middle view could be that markets are efficiently inefficient. That is, that competition amongst professional investors makes markets almost efficient, but the market remains inefficient enough so that these investors are compensated for their costs and risks. There are a number of approaches to equity security analysis. Two broad groups are fundamental analysis and quantitative analysis. Fundamental analysis is what we have been covering in this course. It analyzes an individual firm's fundamentals and forecasts its future prospects, and is often called a bottom-up approach. Quantitative analysis involves the use of technical or statistical analysis of a large number of stocks, and is called a top-down approach. These approaches can be combined to screen securities on some indicator and then undertake fundamental analysis on the remaining firms. This would be a top-down, bottom-up approach. There are a number of important participants in the investment industry. Financial analysts are typically grouped into sell-side and buy-side. Sell-side analysts work for brokerage houses or investment banks, while buy-side analysts work for fund managers such as superannuation funds. Analysts typically cover firms in one or maybe two industries. They issue earnings forecast, stock recommendations, and target prices. There has been much research into the performance of analyst earnings forecast and how accurate they are. Over periods of less than 2 years, analysts are, on average, more accurate than a naive or random walk forecast of earnings. We do know that revision to analyst recommendations often lead to changes in share prices, and also that analyst reports can generate trading volume. One concern with sell-side analyst research is the potential for bias due to conflicts of interest. These analysts may be rewarded for either generating trading volume or appeasing the management of the firms that they cover. Fund managers are another important intermediary in the financial system. They can take a number of approaches to investing. A passive approach means that managers will select a benchmark or index that they wish to be exposed to, and their investments match that benchmark. They do not try to identify firms that might outperform the benchmark. Active investing means that the manager or investor will try to identify firms within the benchmark class of assets that will outperform the benchmark. Managers can also adopt different investment styles. These include investing in value securities, growth securities, or momentum style, etc. There is a large amount of evidence that shows that actively managed funds fail to consistently beat their benchmark, especially when you take into account trading costs and fees. We see this over time and in different markets. As a result, the amount and proportion of money flowing to passively managed funds has been steadily increasing. Have a think about the implications of this research on investing might have for your approach to identifying mispriced shares, both for your major project and the investing choices you'll make beyond this course. I look forward to hearing your views on this in class.